Hi, this is Project Sam. Today's vlog is about not just capital gains tax, but about income or capital gains arising in another country for expats. So an expat can be a tax resident of Dubai, of Portugal, of Cyprus, of the UK, and have their tax affairs in order. And in some of those jurisdictions, they may pay no tax at all, for example in Dubai, or you may only pay tax on remitted income for Cyprus. However, it doesn't mean that every transaction you do around the world is going to be tax-free. So what we're looking at here specifically is any capital gains tax liabilities that you may have. So for example, a UK expat living and working abroad could own property in the UK. When that property is sold, a potential capital gains tax liability arises. Now that's in the past been dealt with in different ways, but since 2015 the laws on that have tightened up quite a lot. So you will be taxed at source on that capital gains income. It's not something that an expat can mitigate if the property is held in their personal name. But now, since April 2020, in addition, you also have to have made a tax return at the time of sale. The small print says within 30 days, but in practice that means when you do the conveyance, you need to do the tax return to confirm that you've made that capital gain and pay the tax that's due straight away. Now, there might be ways of mitigating and offset against other things, but the tax needs to be paid first and then any rebate claimed. So it's quite a big change for expats living and working abroad who own property back in the UK, whether they're British or any other nationality, with a tax resident outside the UK, there is a tax liability that rises in the UK. And bear in mind as well, for UK nationals, capital gains tax is a tax on lifetime gains, but inheritance tax is also a capital gains tax. It's called a different name for two reasons. One, because it's only charged on death, and it's charged on the estate on death, and secondly, it's charged at twice the rate at 40%. So when you die, all your assets are taxed at 40%. There are some exemptions, but even if you're outside the UK and you own a property in the central London and it's worth 1 million, you potentially have a capital gains liability on a sale, an inheritance tax liability on death. And if that UK expat is liable on worldwide income for worldwide assets and income for inheritance tax on death because of their domicile, then that's 40% on the worldwide assets, not just the UK assets. So these are taxes that are very hard to avoid for expats. Another example is rental income. So if you personally own property in the UK and rent it out, that expat has got fixed income arising in the UK. It's the same as if you went to the UK and were working. That income, that property rental income or that royalty income, I wish I hadn't have said that, that property rental income in the UK or any earned income in the UK would be taxed at source in the UK. So there's potential allowances, but the tax rate kicks in. Now it's not to say that you can't offset income overseas. The UK are only going to tax you on your property rental income if you're living and working abroad, but they are going to tax you on that income. So if you've got 30,000 a year property rental income and you've got a 12,500 personal allowance, you've got around about 18,000 at 20% tax to pay on that, which is about it's almost £4,000 of tax to pay in each year, which will be paid under self-assessment if not deducted at source by a rental agent. So that's going to be taxed in the UK rates. Another type of income that can be taxed in the UK at UK rates is a public service pension. Under the latest forms of double taxation treaties, a country like the UK has the right to tax public sourced pensions in its home country. This is not dissimilar to what America and Canada have been doing for years. So if you have a local authority, NHS, civil service, or any form of public civil service, local or national, or forces type pension income when you retire, even as an expat, you could still have to pay tax on that source back in the UK. Now this is relatively new and it's being introduced, but it will give some scope to restrict some of the choices of expats and affect the country where you live in. Now, how can you manage this situation? Well, it's like having any investment account. If you've got a savings account in the UK, you'd look at using an ISA or a property ISA or an investment bond or a pension fund. So there's different ways you can wrap it up to change the ownership, so it's not a personal tax, it becomes within an investment vehicle. These can cost money, but they can also save tax, and you need to balance that up. But there's some simple, effective ways that a UK expat can plan not to be paying capital gains tax at 20, 28 or 40% in the UK by organising their assets to protect their family and their business down the generations and across the borders. And it depends upon which country you're resident in and what the amount of tax at risk is. So even if you've got the lifestyle of your dreams, living and working abroad, there's still action that you can take to protect your family and to protect future generations. For more information on that, of how you can save capital gains taxes and cross-border taxation issues, contact us at proactpartnership.com. UK expats and expats around the world will always potentially have 2 or 3 tax locations looking at them, their home country, the country of tax resident, and the country where the investment asset is held. For more guidance, contact us at proactpartnership.com. Register to subscribe for regular vlogs and emails on the topic, and watch the next premiere and YouTube video, and subscribe to our channel at Proact Partnership Living and Working Abroad. And we'll see you again next time. Thanks for listening.